Graham Neary, and thank you very much for joining me. Another very busy day in the markets with plenty of announcements. I'm also hoping to look at some of yesterday's news that we didn't get around to. So today we've got the likes of Animalcare, Distribution Finance, and Surface Transforms from yesterday. We've got the Hut Group, we've got IQE, we've got Treat, we've got Speedy Hire, we've got Churchill China, and a few others. So we'll see how far we get. We'll go as efficiently as we can. George in the live chat mentions Treat, so yes, that is on my list. Thank you for mentioning it. Please do hit the like button if you enjoy the show, and don't forget to subscribe. And I will try to respond to all comments either on the live chat or on the replay. Okay, so let's share my screen. You may or may not notice that the production quality has improved with some new hardware installed here. Okay, so let's start with, well, I suppose we'll do Treat because it's today's news and it's been mentioned in the live chat already. So it's up by 11% this afternoon, market cap 273 million. And let's get a look at this half-year trading update. I don't think it's too long of an update yet, so we should be able to cover that reasonably quickly. So this company is an ingredients company serving beverage, flavor, and fragrance industries. Tends to be quite highly rated. I've never been too sorely tempted by it personally because it does tend to trade on a fairly high rating, although the share price has been somewhat weak of late, so that may no longer be quite as expensive as it was. Okay, so we've got and hello Peter in the live chat. Thank you for joining us. Good to have you with us. Okay, yeah, so this trading update is pretty good. PBT, or I don't know why they don't just say adjusted PBT, but profit before tax and exceptional items expected marginally ahead of the prior year at £7.5 million. H1 revenue £72 million reflects a subdued Q1. So this destocking word is being mentioned by, well, it feels like hundreds, probably dozens anyway, of companies over the past year. I think after the COVID era, it was a legitimate excuse for many companies because with all the supply chain disruptions, there were instances where companies wanted to pile up their inventories, and then after the supply chain issues were resolved, there was this overhang. So it definitely is a real issue, but it's amazing how many companies mention it. And you know, if you're cynically minded, it is easy to worry that it's being sort of used as an easy excuse. George says the PE of Treat is around 18 currently. Thank you for that, George. Okay, so as you can see, the growth here is well, there isn't really revenue growth as such in H1. A mix of two halves with decline in Q1 and acceleration in Q2. So in the end, H1 revenues were down compared to the previous year. I am fairly impressed that net debt is only £10 million. I think this company probably could carry quite a lot of debt given its fairly long track record. It's a very respectable, decent sized business. I'm sure it could have more debt than that if it chose to. Net operating margin of 11%. So yeah, overall pretty good. Nothing I would say to get too excited about here, but pretty good performance, all things considered. H2 full year profits anticipated in line with expectations. Let's see what they say about their balance sheet. They say they've got an increase in receivables reflects the strong finish to the half-year trading, and we anticipate a reduction in net debt in the second half. So yeah, nothing really going to change there, I would say. And then we've got a CEO comment saying it's a robust performance, particularly pleased with China, where we continue to invest and consolidate, and in our higher margin premium categories, where we have a number of active pipeline opportunities. So look, I've never been the most passionate follower of this company. I always thought it was a good company. I'm not sure if it really deserves to be on a much higher rating than it's already on, but certainly a good quality company in my book, and worth following. And hopefully they can get some momentum going in the next year or two. So that's Treat, and it is up today. So people clearly feeling more optimistic about this one now. Let's go to. I want to cover one of yesterday's stocks. I know there's a lot to cover today as well, but I just thought this Distribution Finance was quite good and worth mentioning. So market cap here is £42 million. I just wanted to have a look at these results yesterday. Now, the only negative here, I think, is that the company doesn't have much of a track record. And hello to Anne in the live chat. Thanks very much, Anne. Nice to hear from you. So yeah, this one, it doesn't really have much of a track record. But it's the sort of thing that I would certainly be open to, investing in and taking a positive view on in the future, because I do like my financial stocks. And this one, DFCH, describes itself as the specialist bank providing working capital solutions to dealers and manufacturers across the UK. So essentially helps people to fund their inventories, I guess. And this was, I thought, an excellent set of results. You can see the headline here: more than threefold increase in PBT and 11 consecutive quarters of loan book growth. So yeah, I just thought these growth numbers really stood out to me. Loan book up 32%, 20% increase in new loans, and an 18% increase in the number of dealer customers. So pretty impressive growth in my book. And the company has seen this operational sort of growth bleed into what looks like an excellent financial result, with net income of £38 million. And I also note that we've got a good tangible net asset value per share here of 55p. So just as a reminder here, the share price is 23.5p. So there's somebody is wrong. Either the company is wrong with an estimate of value that's not right, or the market is wrong by pricing it too cheaply. There's something not going on here, where I certainly get interested when I see financial stocks trading at these sorts of valuations. Now we do have a Q1 update in here. So I won't be going through all of these numbers. Don't worry. I know we haven't got all day, but let's just have a quick look at the Q1 outlook here. So again, we've got really aggressive growth, 22% growth in loan origination, loan book up by over £100 million to over £600 million now, compared to a year ago. So that's about 20% growth. And they say they are focused on dealer credit quality, but still the number of dealers is continuing to grow well. And then arrears, they're very proud of the arrears performance as well. So look, I know financial stocks aren't for everybody, but I certainly find them to be a good source of investment ideas, and I've tended to do reasonably well in financial stocks. So I would be keeping this one on the watch list for sure. Seems like they are ambitious and still early stage, but could be a good time to start researching them at this early stage. I see they've got ambitions of an £800 million loan book. So yeah, I think this one is worth a look. Doesn't get mentioned much, but might be going under the radar potentially. So that's distribution finance. Another one from yesterday that I thought was worth a look was Animalcare. This is a company that I used to study more than I do now, but I like the concept because it seems to me that people are only going to become more interested in spending on their pets as time goes by. And so we had full year results for 2023 from Animalcare. And I suppose the main point really is just that it's in very solid financial health. They have a net cash position of £27 million as of the end of February. So that was after making a disposal. But even before making that disposal, I think they still had, or they were very close to net cash. You can see at year end, they had a very small net debt position. So they basically eliminated their net debt. And I've noticed that they are trying to be more focused. So, a lot of companies that you study, they confuse you because they have too many different parts and the parts don't seem to be related to each other properly. In the case of Animalcare, they've made a disposal of something that they thought was non-core. And if you're interested, they do talk a lot in this result statement about how they're trying to really focus going forward strategically. Let's see if I can sort of hone in on this point. Let's see, scrolling down, strong performance, organic growth, inorganic growth. Yeah, so I think that this is a good business, and I've been impressed by its balance sheet, which used to have quite a significant amount of debt. Let's just quickly read out the outlook here. Looking ahead to 2024, we will continue to push for profitable growth and cash generation. They are open to inorganic growth opportunities, but they also build their own products, so they have their own R&D pipeline, and they say they're better equipped than ever to accelerate growth. So the only downside in the numbers is, again, just that growth in 2023 wasn't very impressive. 3.8% at constant exchange rates, actual exchange rates growth was 3.8%. So not a great year in 2023 for growth. They explain it by saying there was a normalization in the rates of demand growth across our markets due to the changing macro environment and country-specific dynamics. So that's probably the main weakness here in the investment case, the lack of growth. But apart from that, I think it's quite a decent company. Informer is back in the live chat. Nice to see you again, Informer. He or she says, stocks and commodities are booming. What's all this cheap talk? The only cheap stocks are unprofitable stocks. Well, I beg to differ, Informer. But thank you for expressing your view. Okay, let's move on from Animalcare, and let's take a look at Saatchi. So we've got SAA, so M and C Saatchi. Decent market cap on this one, 200 million pounds or so, and we've got full year results out today. So let's see, what's the point here at M&C Saatchi? Material profit improvement in H2, encouraging Q1 like-for-like momentum. So yeah, this is a business that I don't think it's in the sort of high quality end of the spectrum by any means, but it's it's a decent business. Let's see if we've got some decent profit numbers to look at here. So it only goes up to 2022 here, but a bit of a mixed bag on profitability from M&C Saatchi. And let's just get the outlook statement. I don't think I'd want to spend a huge amount of time on this one, but let's just get the outlook. Confidence in meeting 2024 expectations is underpinned by encouraging Q1 momentum, despite continuing macroeconomic uncertainty, improved free cash generation in 2024, and we are confident that the structural changes we are making to our cost base, alongside our new operating model, are increasing our operational leverage. So look, I'll keep an open mind on this one, but it's never really spoke to me as being a high quality company, but worth mentioning in passing. Okay, let's move on. That's M&C Saatchi. Let's look at a company that I do think is high quality, Churchill China. Oh, and Peter's in the comments again. I used to sell Animalcare products, good quality. Thank you very much for that insight, and I would not be surprised if that was absolutely true. Okay, Churchill China. So this is providing a total tabletop solution to a market which demands the best results from its tableware, and so the China companies, not China as in the country, but China as in tableware companies, they do tend to have good, high quality metrics. And the only thing is they've had some fairly volatile results the last few years. But at the bottom of it, I think these are good companies, with brand names and usually with pretty good returns. So let's take a look at these final results, which have been published this morning. So again, we've got a challenging environment. However, despite the challenging environment, profit before tax did rise 12%. So pretty impressive. A bit like other companies we've looked at, where revenues aren't moving, but still grinding out decent profits. And another nice aspect of this one is the cash position, net cash of nearly 14 million pounds. So a few good points to take away from this one, I would argue. And people who follow this stock long term might be minded to possibly take a nibble, on the basis that the challenging environment that it's currently suffering won't be around forever. Currently, we've got trading in line with expectations as far as Q1 is concerned. Continuing focus on productivity and waste, and further investment in strategic growth areas. So yeah, I like these old China companies. They're been around for a good long time, generally performed very well over throughout their history. But when you have a consumer crisis or cost of living crisis and high inflation, and you have headwinds on certain consumer spending categories, I don't think we should be too surprised that companies like this might run into some troubles. El Saint is in the comments with a question. I will get back to you on that one, El Saint. Thank you for the question. Okay, so is there any other key points we want to take away from this Churchill China stock? Let's just dwell on the outlook statement for a minute. We have delivered an improvement in operating profit and margins during the year, despite flat revenues and strong headwinds, particularly in our hospitality markets, which, as an aside, is something I think is totally acceptable and reasonable, and investors shouldn't be shocked by that. Volumes were down year on year, driven by softer demand in H2. We believe this trend will continue into H1 2024, but we are confident that the continuous improvement in our product range and market position, backed up by our ongoing investment program, has placed the company in a strong position to take advantage of a market recovering from current weakness. So, I mean, look, I think this one just goes back to the sort of mindset you need as an equity investor. As an equity investor, I think it's important to be optimistic and to think long term. Sometimes that comes back to bite you, but this one seems like it's very well exposed to markets which will thrive in an economic recovery. And of course, we've had a very shallow recession. Maybe we're going to get back into a strong economy sooner rather than later. That's certainly what I'm hoping up for. So yeah, well, we leave Churchill China for now. Unless anyone's got any other comments or questions on Churchill China, maybe we'll leave it for now. Now, El Saint in the live chats asked, is there any way to distinguish between current and non-current assets at distribution finance? Well, in general, for financial stocks, you don't get a split between current and non-current. So in general, for financial stocks, you get what's called a liquidity-based presentation of the balance sheet, where assets are presented to you in order of their liquidity. So the most liquid assets are at the top, the least liquid assets are at the bottom. And that is how financial stocks work, because they don't have inventories in the way that a normal sort of physical company does. Let me scroll down here and see what you're looking at. So yeah, this balance sheet from distribution finance is presented the way I just explained. Cash being the most liquid, and then we've got some short-term assets, and then as the categories go down and down, they become more and more illiquid. If you want a practical suggestion, I would just treat this loans and advances to customers as, if you like, I mean, it's sort of equivalent to inventory. And then the other categories don't really matter very much because they're so small. So if you want a practical suggestion, I would just focus on loans and advances to customers, and really don't really spend any time studying the other categories except for cash. Cash is worth having there, but the others, I don't think they even matter. So you can't treat this balance sheet the same way that you would the balance sheet for Treat or Churchill China or anything like that. It's a totally different beast, and maybe that's why financial stocks become a sort of a specialist area, because a lot of people don't want to, don't have the time to study these weird balance sheets. But no, in the case of distribution finance, I don't think any of those categories actually matter, except for cash and loans to customers. Okay, where will we go next? Let's take a look at Speedy Hire. Hire companies always sort of seem to say something interesting. Though it's not easy to find a high quality hire company in my experience, but Speedy Hire certainly has a lot of credibility. Big company, 300 depots. Let's take a look at what we've got today. We've got a year-end trading update from Speedy Hire, describing itself as the UK's leading tools and equipment hire services company. And they have performed resiliently in the year against a challenging market backdrop. So a lot of these companies using the same vocabulary, perhaps that's to be expected. Wider macroeconomic uncertainty. But they've got revenue down 5% to £420 million, impacted by underperformance from our regional base, the reduction in wholesale fuel prices, and the performance of our seasonal products, which were affected by the warmer winter period. I mean, look, I'm not massively surprised to see that Speedy Hire has had a challenging period, but they let's see what we've got in terms of outlook. So, despite the challenging trading environment, the group has secured additional annual turnover in excess of £40 million across multi-year contracts. And this gives confidence for growth in the new year, FY 2025 and beyond. So, yeah, they're not certainly not throwing in the towel. They're looking forward to growth in the new year, but then they also say that results for the year will be towards the lower end of the board's expectations for FY 2025. So a bit of a mixed bag here. Again, remember that they are carrying net debt. Generally, hire companies do have to carry debt because otherwise it's not really possible for them to earn a good return on equity. So in some ways, you could argue a hire company is like a financial stock, because they're borrowing in order to fund inventory which they loan out. So yeah, there are definite similarities with financial stocks here. Personally, I'm not likely to ever invest in a hire stock, but I do find that they do give you an insight into economic conditions, and so like many companies, Speedy Hire is challenged but hopeful for the new year. So not much more to say on that one, really. Let me know if you think Speedy Hire is a good investment idea. Lemon Physical is with us in the live chat. Nice to see you again, Mr. or Mrs. Don't you think Speedy lost any credibility when 20 million of equipment went walkabout due to poor controls and accounting procedures? Bread and butter stuff for a hire company. Well, thank you for the comment. I appreciate that. Okay, as I said, I don't think I'm ever going to be a shareholder in Speedy Hire, but I do like to know what they're saying to us in terms of the economy. All right, let's go to another company that reported today. We've got the Hood Group. This one really does bewilder me. I must say. Okay, let's see. So market cap here, £815 million. It's down 10% today. Well, I've never really understood what the attraction here is, if I'm honest. Profitability just seems to be um, very sort of illusory, let's say, and and then you ask what the businesses are doing, and it just I don't see I don't understand it. I don't understand how it can be worth £800 million, and I suppose the thing that bothered me about it, again being somewhat blunt, is that the Hut Group was sort of presented as a high tech situation, or it was presented as something that was revolutionary. And then you look into it and it's just sort of protein powder and beauty products. I didn't see anything high tech or revolutionary in it. So I suppose I've always been a bit of a skeptic on this one. And you can see we've got adjusted EBITDA of £114 million, and then an operating loss of £185 million. So I'm always looking for companies where, even if they present adjusted EBITDA, the difference between adjusted EBITDA and the actual result is not that big. But that's clearly not the case here. And it has been around for a few years. It's not like a brand new company. It's been around for a while now, and it just always seems to be this way. So I don't get it. I see, and now that we've got a CEO comment here. Okay. In 2023, we made material progress against our strategic priorities, delivering significant profit growth following the support for our consumers through the cost of living crisis in 2022. This focus led to the group delivering record EBITDA after cash adjusting items, higher than at the peak of the pandemic. Having completed our recent infrastructure investment program, the group is now delivering operating leverage. Our fulfillment network is becoming increasingly optimized through a combination of robotics, automation, AI, and the onboarding of new Ingenuity clients utilizing existing capacity. So, I mean, look, others may differ. If you like the Hut Group or THG, good luck to you. But I don't understand it. I don't see this as a robotics company. I don't see it as an artificial intelligence company. And yet the fact that the CEO is talking about robotics and AI at the top of this result statement, it just comes across as not really believable to me. I don't believe there's any value here from robotics and AI, but perhaps I'll be proven wrong. And then we've got current trading and full year guidance. Overall, group revenue trends continue to improve, with notable momentum in beauty following the strategic changes made during 2023. And the group's start to the year provides us with confidence in delivering in accordance with market consensus. So it's a bit strange that the market cap is down, or the share price is down by 10%. We do have this warning about the yen, which has impacted THG Nutrition. But in the same sentence, they say that they have confidence delivering in accordance with market consensus. So, from that point of view, you'd think, well, investors should be happy enough with that. But no, the share price is down 10%. And this also sounds reasonably positive. Operating cash flow is expected to remain strong, supported by profit growth and lower capex, which will drive further free cash flow progress. So, I mean, that sounds pretty good. And then they've also said medium-term guidance is unchanged. So you'd think investors would be reasonably happy with all of that. Personally, I remain bewildered, and I don't understand the valuation, and I don't understand why it presents itself as a robotics and AI company. You know, they have this division called Ingenuity. Peter is in the live chat. That's not very kind of you to say about the company, Peter, but I'm not going to argue. So yeah, we've got this Ingenuity division, and it says comprising leading digital marketing technology and fulfillment capabilities. Ingenuity utilizes its experience in building category-leading brands to offer global e-commerce solutions for brand owners and retailers. So, I mean, it feels to me as if we're kind of being invited to think of this as some kind of Amazon 2.0, or as, you know, some kind of high-tech logistics company. And I'm not going to argue that it's, you know, that it doesn't provide real services, but I suppose the bit that bothers me is the presentation of it as a robotics or AI company, and also the poor financial results. But I suppose a lot of good investors were very skeptical of Amazon for many years, and Amazon proved that it could eventually be extremely profitable. So maybe that's the argument. Maybe THG Ingenuity is going to make me look like an idiot, but for now, I remain a skeptic of this share. Okay, where will we go next? Still quite a few things we could cover today. I don't think we'll have the time to cover them all, but let's try this one, ETX. Okay, so Therapeutics, an Oxford-based business with a revolutionary computer-based platform and a unique network-driven drug discovery methodology. So that sounds pretty exciting. Share price is, however, down 11% today. Market cap about £65 million. And so yeah, here's the news. It goes back to what we were saying about whether AIM is a good place for companies who have a lot of fundraising needs, and you know, whether they would prefer to be private and raise money in the private market or somewhere else rather than to be on AIM. So this is pretty big news for Therapeutics. Let's start with the fundraise. We've got a £29 million fundraise before expenses by way of subscription, and that is at 15p. So the share price only 11p now. So it's interesting that it would fall. Well, I suppose we're going to get to the other news now, which will explain the fall. But interesting that it would fall further below 11p on this announcement. So continuing, the company has a current cash position of approximately £18 million. And the gross proceeds from the fundraise will considerably strengthen its balance sheet. In addition, the company has an intention to cancel its admission to AIM and subsequently explore the option of listing on NASDAQ in due course. So what is this? Another nail in the coffin of AIM? Certainly doesn't look good. Here's what the CEO says. For over a year, the board has been contemplating delisting from AIM. However, given the dramatic rise in the US biotech indices in Q3 23, which has seen a record amount of capital being raised, we decided to remain on AIM and embarked on a capital raise roadshow in February-March 24. Despite the firm commitments given by our two largest shareholders, the board was extremely disappointed by the lack of institutional UK interest in our innovative technology-driven value propositions. And he says they struggled to get sufficient engagement from the vast majority of the institutions who were approached, reflecting the risk appetite of the UK markets. So certainly it's a bad look for AIM, and it's a bad look for AIM investors and the funds who invest in AIM when you have a company that is saying we're done here, we're going to the NASDAQ because you're just not interested. He says there is a limited available audience on the AIM market for companies such as ETX. Look, I'm one of those people who doesn't know much about ETX or eTherapeutics, but all I will say is that I think the context here is important. We've had outflows from UK-focused funds that have been persistent, basically for years at this point. It just goes on and on, the outflows, and it will stop at some point. And when it stops, then companies like eTherapeutics may find that they've got more of an audience. But a lot of fund managers, especially at the smaller end, are they're redeeming. They're not buying new shares. They're redeeming for their existing customers. In other words, they're selling shares. So they're just not able. They may be interested, but they're not able. A lot of the funds. So that's what I'd say. I'd also argue that they may find that in the NASDAQ things aren't as straightforward as they expect. Because a lot of the small caps in the United States are not trading in a way that they traditionally would have either, because the number of active investors in US small caps is not that huge proportionately either. But maybe I'm sure they will find another audience there that may be more receptive, but I don't think it'll be a walk in the park there either. Now, hello to Giles in the live chat. Thank you very much for the comments. And he says that the MNC Saatchi results look okay with encouraging noises from management and poised for recovery and poised to benefit when the economy recovers. So thank you very much for that input. Appreciate it. So maybe there's not much more to say about eTherapeutics. I don't know many people who studied the company, so I guess we're part of the problem that we've not studied the company. But I suppose they really wanted institutional money, and they've not got it. So that we may see them exit stage left before too long. Okay, let's go to IQE. All right, IQE is up 34% with a market cap of £258 million. We've got a double-barreled RNS release from IQE. So this is a company I've grappled with a little bit in the past. I always felt that it was more of a manufacturer with fairly low returns on capital rather than a high-tech business that a lot of people sort of seem to perceive it as being. But let's take a look at this. CEO comment says, I am pleased with the resilience of the business. despite 23 being a particularly challenging year for the semiconductor industry. So again, the same language being used that we've seen elsewhere. He says, as forecast, IQE returned to double-digit growth in H2 over H1, and additionally took strategic actions to reshape our cost base as part of our ongoing commitment to improving margins and profitability. And he says IQE is well positioned within the global value chain to deliver sustainable growth and capture opportunities in 2024 and beyond. So yeah, we've got revenue here that is obviously down considerably. Not a great result in 2023, it must be said. Adjusted EBITDA barely positive, and an adjusted loss and a reported loss that are both meaningfully large. So pretty poor results there. But then let's move on to current trading and outlook, because of course markets are forward looking. There are increasingly positive signs that the global semiconductor industry is recovering from what has been an unprecedented cyclical downturn in terms of both its extent and duration. IQE saw recovery in H2 23, which has continued into Q1 24, with inventory levels beginning to normalize and customer demand recovering. Trading in Q1 is in line, the order book is strengthening, and they expect to see the improvement continue through 2024. And they confirm revenue and adjusted EBITDA for the year. And very helpfully, they give us the analyst range of expectations, which I think all companies should do. So well done to IQE for giving us this. Analyst range of expectations for FY24 revenue. Quite a wide range, between 133 and 153 million pounds, adjusted EBITDA between 11 and 17 million pounds. But I suppose the bit that I come back to on this, and why I would argue that this is not, it's a manufacturer rather than a sort of high tech business, is just remember this number. We've got adjusted EBITDA of 11 to 17 million pounds. And if we go down to the balance sheet, you'll see that we have total assets of 273 million pounds and net assets of 170 million pounds. So you see, even if they hit that top end of expectations for 2024, they would still only earn adjusted EBITDA that was 10% of their net assets and much less than 10% of their total assets. And of course, adjusted EBITDA is not the same thing as after-tax net income. So, generally, in my opinion, most companies need to earn a return on equity of about 10%. Okay, some would argue 7% is fine, but generally I want to see a double-digit return on equity if possible. I understand it's not always possible, but my point here is that I just don't see IQE hitting a decent return on equity, and that's in 2024. After a few bad years, and that's the top end of 2024 expectations. So I suppose that's why I've always been a bit negative on this company. I just don't see it earning good returns. But I know it has a following, and I respect that. And if you like the company, feel free to let me know why you're a fan. Now let's take a look at this partnership announcement. And thank you very much, Giles and Tom, for the comments in the live chat. I appreciate it. So yeah, let's go and look at this partnership announcement. IQE, the leading global supplier of compound semiconductor wafer products and advanced material solutions, is pleased to announce an expansion of its partnership with Advanced Wireless Semiconductor Company with a multi-year supply agreement. So IQE will supply wafers. So that's the main product from IQE. These wafers, not wafers that you eat, by the way, or at least not recommended, for the manufacture of smartphone power amplifier devices to be supplied to its key customer Lances, the Chinese RF technology supplier. This will supply Tier 1 China-based OEMs in the Android ecosystem in a market which is expected to return to growth following a period of inventory buildup. So certainly a positive announcement, and I've never argued that IQE does not have high quality customers, blue chip customers. I know that it does. My argument has always just been that it's not a high return business. It does not earn high returns on capital, high returns on equity. In other words, it's a manufacturing business. Okay, so but well done to IQE shareholders. Shares are up 35% today, up 7p to 27p. So certainly well done to anybody who was holding that one overnight. Informer is in the comments again. In the USA, say artificial intelligence and your stock goes up. In the UK, say cost cutting and stocks go up. Yep, very different cultures, absolutely. Okay, so that is IQE done. Now we are pretty much 52 minutes into today's broadcast. Still a handful of stocks that I could cover, but I think I'll save them for tomorrow. There's only 2 or 3 stocks that I haven't covered for today. Be good to have them in the back pocket for tomorrow, depending on what news flow is like tomorrow. So please subscribe to the channel, help the channel grow, give the thumbs up, helps the channel greatly. And I hope you noticed that the production quality today was better than yesterday. We're in a new world here with better hardware. And I'll see you again tomorrow at 12:30 p.m. Or whenever you're free to watch the video on replay. So thank you very much, and thanks for the company, thanks for the comments, thanks for that, Tom, and bye for now. See you tomorrow. Good luck.